Hello everyone. Welcome once again to Kotak Securities Weekly Fundamental Podcast. I'm your host Rini Mehta. Last week, both Sensex and Nifty gained around 1.7%. The Indian markets were buoyed by falling crude oil prices and a decline in domestic bond yields. Autos were the top losers, while banks, capital goods, and healthcare were the top gainers. If we look at the stocks under the Nifty index, Bajaj Auto, Tata Motors, and Nestle lost the most, while Shree Cement, Adani Ports, and Tech Mahindra gained the most. On the economy front, August exports contracted by 1.1% year on year, while imports increased by 37% year on year. Now, given the lack of major domestic events, Indian market sentiments will be influenced by its global counterparts. Across the globe, investors will be keeping a close watch on China's inflation numbers. The volatility in oil prices and USD INR will be other important factors that may affect the market. Investors need to watch out for stock-specific news in this week. Also in the global markets, the European Central Bank announced a 75 basis points interest rate hike, taking its benchmark deposit rate to 0.75%. The bank also revised up its inflation expectations to an average 8.1% in 2022 and said it expects to hike rates further as inflation remains far too high and is likely to stay above target for an extended period. So US stocks remained under pressure during the week as expectations of the rate hike this month grew on Wall Street after the Fed chair said again that he is strongly committed to bring down inflation. Now coming to the FPI flows, FII flows were positive in the month of September till date. They were net buyers to the tune of rupees 3,837 crores till date. The Indian markets were buoyed by falling crude oil prices and a decline in domestic bond yields, as I said. So given the headwinds in the terms of monetary policy tightening, rising inflation, geopolitical concerns, etc., FII flows are expected to remain volatile in the near term. And any meaningful fall in crude oil prices will be positive for Indian economy. Now I would like to share an update on Container Corporation of India. So to us, the emerging details of the revised land license policy are negative versus our expectations. So a container corporation may have more to lose if it considers rebidding its Indian Railway terminals in search of lower land license fee or LLF. Our unchanged fair value for now at rupees 730 yields prospects of time correction over the next 1 year. It also bakes in the benefit of effective payout to Indian Railways at 3% LLF rate versus 6% at present, and thus is prone to downside risks. So our fair value would fall to rupees 690 if there is no change in LLF for Container Corporation's existing terminals. So we downgrade the stock to reduce from an add rating earlier. Lastly, our pick of the week is CESC with buy rating and the target of rupees 100. CESC reported strong headline growth primarily on the back of higher unit sales that did not necessarily lead to earnings growth under the cost plus tariff framework. Although lower effective tax rate of 17% did aid in boosting PAT growth. Dhariwal appears to have settled with improved PLF on the back of a medium-term agreement supplementing the already in place long-term agreements. So we maintain buy with a revised fair value of rupees 100. So guys, that's all for today. See you again next week. Signing off. Thank you.